we finna go live. All right. Just redirect into YouTube. All right, and so we are live. Excellent. All right, guys, let's get after it. After that brief or not so brief moment of technical hitch, we're good. Cool. So let's wait for everybody to get back in after having to kick everybody out. Welcome you guys once again. How we doing?
Good, thank you. How are you?
I'm good. Be on your best behavior. You're on YouTube.
Well, I'm saying hi to you.
Yeah, no, I'm just saying be on your best behavior. I know you're just saying hi. I'm just warning you in advance to be on your best behavior. That's all.
It's
your track record. Your track record.
And the answer is yes. I can imagine. Yes.
Honestly.
Yes, I can imagine.
Hey.
Right. So let's get my chart set up. You know when you pull out of a trade and then wish you hadn't? That's the trade right here. I was in and then it was messing around. So I decided, nah, just get out of it. And then boom. After midnight, it just took off. And I was doing pretty much exactly what I've been waiting for it to do all week. It's doing it now on a Friday. But anyway, one of those ones where it's a good one because you didn't lose money on it, even though you didn't make money on it. Let's see what's going on in AU and EU. Yeah, AU is still hanging around. EU is also moving down as well. I was in both trades south, as you can see from here. In both trades south, and I just got tired of them hanging around yesterday. So going into midnight, I closed, woke up this morning, and boom. Right, so yesterday, we were looking at, quick second. So can you guys see my charts, right?
Yes.
Yes.
Okay. So, 1 second. You're probably looking at yourselves now on my screen, right?
Yes, sir.
Okay, so let's get you off. Not that you're not nice to look at, but
Oh.
yeah,
Really, it's Friday. I'm telling you.
it's all love. You guys know it's all love, I think.
Oh, my days.
If I discover otherwise, I'll let you know.
Okay.
So, let's get these PowerPoint slides up. So we were looking at how to apply all these beautiful, wonderful principles together to actually take a trade, right? To find trades and to take them, because it's all well and good knowing about market structure breaks and stop hunts and all these bad and beautiful things. But if you don't know how to apply them to actually find a trade, enter the trade, and win the trade, or at least mitigate your loss correctly, then it's useless. So we looked at the concept of, and I've taught this before theoretically, but we began to look practically at the concepts of picking a scenario. One quick second. Of picking a scenario or stalking a scenario, then generating and recognizing a signal. And then we ended starting to talk about taking entries, if you remember, right? So we ended starting to talk about taking an entry, or how to use an entry pattern, which is where we were yesterday. So I'm not going to go through these again. Just go back to the video. It's a private video on YouTube, but it's available to you students. A scenario is a big picture hypothesis, meaning an educated guess. Not a gamble. A hypothesis is not a gamble. It's an educated guess. It means based on certain principles, you have good reason to believe price is going to do something. You want to frame your scenario on at least one time frame above your signal time frame. Meaning if your signals are generated on a 1 hour chart, you should be framing your scenario on a 4 hour or above. I also mentioned that after these 2 sessions, I wanted you guys to be ready to start to stock signals on a 1 hour chart.
Yeah.
That as you improved your experience, you would figure out what kind of trader you are, whether a scalper, a position trader, an intra-week or whatever. But to begin with, the 1 hour as a signal time frame is kind of in the middle because it gives you enough signals to practice what you're learning, not 1 or 2 a year, but it's also reliable enough not to be too noisy. I showed you why I like the 1 hour chart practically myself, and I think I proved how reliable it can be, especially for intraday and intra-week signals. And then we looked at the concept of a signal. Now, when people say signals in foreign in forex or trading, especially what we call signal providers, what they mean is somebody sends you an email or a text message saying, enter this trade here, put your stop loss here, put your take profit there. That's not what I mean by signal. What I mean when I use the word signal is a set of confirming events in your signal time frame, something that happens on the time frame you choose to pick your trades off directly, that says to you that scenario that you were planning, that you were stalking, it has happened exactly as you thought it would. These can be things like candlestick patterns, market structure breaks, top points, intermediate liquidities, price levels like institutional levels, the big figure, the mid figure, the lower and upper quad. That's the 00, the 50, the 20/25, or the 80/75 levels. Key levels like previous daily or weekly or monthly highs, lows, opens or closes, Fibonacci levels, things of that nature. It could be liquidity profiles, an order block, a manipulation block, a momentum gap, a fair value gap, a high, a low, a time period, meaning between New York, London, Asia, whatever it is. Combinations of these concepts that tell you, okay, we're good to go. Right? That thing you thought was going to happen, it has happened. And I said to you that unless you are scalping, you should only take signals in the direction of your directional bias time frame. Now, your bias time frame should be at least one time frame above your reference time frame, and your reference time frame is the time frame you frame your scenario on. So if you're framing your scenario on a reference time frame, you take a signal on at least one time frame lower, but the signal time frame should line up with a bias time frame, which is one time frame higher than the reference time frame. And I know that sounds very confusing, so let's go remind ourselves again on the charts. If my signal time frame is a 1 hour, my reference must be at least a 4 hour or above. It could be higher, but I cannot frame my scenario on anything lower than a 4 hour time frame. Right?
Right.
You guys remember that, right?
Yes, sir.
Come on, talk to me.
Yes,
Holler
sir.
at me. Cool.
Yep.
So if I'm generating signals in a 1 hour, I must be framing my scenarios on a 4 hour or above, and I must be using at least a daily or above as my directional bias. Does that make sense? So I should not be taking any signals on a 4 hour time frame, on a 1 hour time frame, sorry, that go against my daily bias. And up until today, my daily bias was bullish. It looks like today will give that reversal I've been calling for all week. It waited till Friday, annoyingly, which is why I got out the trade, because I entered the trades yesterday and they kept dancing around sideways. And I just thought, you know what, forget this. And then I woke up this morning and boom, it's one of those days where something happens in Asia. they happen once every, I don't know, once every week or so. Just so be it. And so I'm framing my big picture. So for instance, in essence, if I'm doing Fibonacci's, if I'm doing market structure breaks and stop hunts, all those things, that's why the way Tokwe and I taught you guys to start generating signals, we taught you to look for a 4-hour stop hunt because that's the reference time frame. That's where you are doing your scenario. So like I showed you yesterday, there's a 4-hour stop hunt here. There's a market structure break there. Price moved up, came back into the area. That's a 4-hour scenario. Because up until today, and today could still close bullish, it's not over yet, but right now it looks bearish. Up until today, so far this week, the bias had been bullish, meaning upwards. It therefore means that we would not be taking any signals on an hour chart that were bearish. Now, I was cheating that on my demo account because I believed there was going to be a reversal. So I was only doing this on my demo, not live. I wouldn't take a trade on my live account against the daily bias. Now, because I saw signs of a bearish reversal that happened today, I was a day late. Now, the question is, how do you enter? Right? Well, like we said, an entry pattern is a chart of price action setup that repeats consistently with reliable parameters. It can't be something that you change every day. You have to have studied the chart or learned it from someone and have proof that this thing happens the exact same way. It has to be precise. There's no room for flexibility as we go along, right?
Mm-hmm.
It has to be precise, objective, consistent, and reliable. And we looked at the fact that when you're choosing an entry pattern, you want to take into account the following. One, the risk to reward ratio. Are you likely to get at least 3, 4, 5 to 1 if it's not a scalp, and at least 2, 3 to 1 if it is a scalp? How large of a stop loss do you need from where you're entering? Does that line up with your rules and parameters? And what's the frequency of your signals? How often will this entry pattern give you a signal? We spoke about the fact that you can have the same scenario and the same signal. Actually, that shouldn't say signals, say frequency of entries. You can have the same scenario and the same signal and 2 different ways or more to enter. Now, I gave you an example to end last week or yesterday's session. Let's get a brand new chart. Okay. So I gave you a scenario of how I do my entries. Remember? And for me, my primary entry pattern, let me find an example here. My primary entry pattern is a stop hunt, or what I call intermediate liquidity, into an order block and a 1-hour engulfing candlestick pattern. And when I say engulfing, I don't just mean the classic engulfing like a harami or whatever. I mean any candlestick, any 1-hour candlestick that reacts to that zone. So this here is a valid one. I also want to see a discount if I'm going long or a premium if I'm going short. So this is a perfect example here, right? In that Fibonacci, we're down here into discount, right? So price has given me a discount. It's taken out intermediate liquidity here. That low there is the intermediate liquidity. It's come down into an order block or manipulation block. And I have a 1-hour rejection candlestick pattern. Does that make sense?
Yes.
That is, so let me give you an example of how that entry pattern works with the scenario and the signal. The scenario would have been on the 4-hour chart, right? My previous scenario is I want to see the first 4-hour stop hunt of the week. Again, there are other scenarios. I'm just giving you mine. As you learn the precept, the concepts we're teaching, you will come up with the ones you like best. So we're teaching you these ones to start to get you off the ball, but there's several others that I know. I just like this one. It works well with my brain. So I want to see, right, the first 4-hour stop hunt of the week. That was here, right? Right, guys?
Yes.
Yes, sir.
The week started here. Well, actually, that's not true. This was the first hour. This was the first one of the week. So let's do it this way then. Let's go the other way. So this is the first 4-hour stop hunt of the week. Can you see that there? In fact, that wasn't the level it stop hunted. This was the level it stop hunted. It violated this one. Like I told you, once it passes through, it doesn't respect it. Just delete that line. So this is the first one it stop hunted, right? Can you see that there?
Yes.
So I told you once that happens, once you see that there, every time you see it violate a 4-hour high, you drop down to a 1-hour chart to check for a 1-hour stop hunted market structure break. So we'll check this one and then this one. The first one was here. When it passed here, did we at this level see a 1-hour stop hunted market structure break? No, we did not, right? One quick second. Let me just, I think someone's trying to get a hold of me on, okay. Right, so can you see here that when price got to that level, did we have a stop haunted market structure break? It's not a trick question. Come on, guys.
On the first one, sorry?
Yeah, the first one. Did we?
No.
No. So the moment price blows past that one, right, and gets to the next one, you just delete that line. No signal there. Here, we see a rejection. Okay. So price goes through it and comes back out. We start hunting. Where is now in this case, where is the high that drove price into the stop hunt? That is here, right?
Mm-hmm.
Come on, guys, talk to me.
Sir. Yes, yes.
That's here, right?
Mm-hmm.
Yes.
Cool. Let's put that in blue to 1 hour. So we wait for it to clear that low there. It clears it here. The moment it clears it here, we start looking for a potential reversal. That happens. There's no reversal there. No reversal there. No reversal there. We then get one here. Although it comes back out here. So we're going to draw Fibonacci from high to low.
Sorry, what's the difference between retracement and reversal?
A retracement is a kind of reversal.
Okay.
Yeah. Retracement simply means that it's coming back into a Fibonacci range. Reversal is anywhere where price changes direction.
Okay, okay.
So a retracement in itself, a reversal is what starts a retracement.
Okay.
Right? Now, remember? Okay. Let's just tell it. Okay. Nah, okay. So remember we said it's not a live trade, a live Fibonacci till it gets back to the 38.2. Did it get back to the 38.2 here?
Mm-mm.
Did it get back to the 38.2 there?
No.
No, it didn't.
No.
So this is a trade that you would have said, man, I didn't get an opportunity to take it. And that's fine. following your rules will cost you some trades that you could have gotten into, but they'll save you from more trades you shouldn't have gotten into. Does that make sense?
Yes.
So this particular trade, you would not have had a chance using these sets of rules to be a partaker of. That's fine. You wait for the next opportunity.
But sir, I know you would. You used to say something about deep discounts and a sweet spot in between that 38.2 and the 21 point something. For
That's when you're going long.
okay.
In this case, you're going short. So
Okay.
if you're going short, when you have a Fibonacci range, if you're going short, you need to at least get back to 38.2. If you're going long, when it comes back in, you need to get back to at least the 61.8.
Okay.
In essence, price must come back into the fair value region before the Fibonacci is live.
Okay.
Does that make sense?
Yes, sir.
Cool. So on that one, you just let it go. Now, there's a cheat I can see that I could have used to get in, but I don't want to confuse you with that right now. At this point, just follow the rules as you're given them. So you don't get that trade. Fine, you let it go. You go back to a 4-hour chart to start looking for another scenario, right? You clear all the lines off your chart, you go again. Where is the next 4-hour stop hunt this week? It's down there, right?
Yeah.
Can you see that?
Mm-hmm.
So
Yeah.
you don't do anything on this pair until your scenario is triggered. So all the way between, let me see now, this was a Monday, all the way between Monday, the 3rd, and this was, so that was Monday, sorry. That was Monday at 4 or 2 p.m. So 4 p.m. server time is 2 p.m. London. So that's Monday at 2 p.m. till the 5th was 2 days ago, right? Till Wednesday at 2 p.m. For 48 hours, go enjoy, spend time with your family, take your boo out on a date, watch Netflix with yourself if you want to chill, all those things, right? Just
Yeah.
putting that in there.
Mm-hmm.
And then and if you have a form of automation, if you have an EA or a robot, it will tell you at 2 p.m. on Wednesday, we've just had another 4-hour stop hunt. Then you start watching again. In essence, you don't have any business looking down beneath the 4-hour chart until you see that. Does that make sense?
Yes.
Even though your signal time frame is a 1-hour time frame, you don't drop. Well, I mean, you can just a study, but in terms of getting a trade, you don't have any business going beneath a 4-hour chart until you see that happen. Until you see price take out a 4-hour high or low. Now, you would have had a false signal here. On Tuesday, price would have taken out that 4-hour low, right?
Yeah.
1 second. Oh, come on. There's a 4-hour low there.
Yeah.
You can see it, right?
Yeah.
Right. So on Tuesday, your automation software, if you have one, may have told you, oh, we've just gone beneath the 4-hour low. Okay, fine. Let's drop down to a 1-hour chart. You come down to a 1-hour chart, and then you ask yourself the same question again. First of all, when price crosses there, does it come back up? It does. Right? So once it comes back on the other side, you then ask yourself, where is the high that drove it into that low? It's that one there. So that would be the market structure break level. Once price crosses this low, does it come back up to break that level? That's the low. When price dips beneath it, that's the last high in blue before it dipped beneath the low.
Yeah.
Does it get back to that high?
No, it doesn't.
So do you have a signal?
No.
No. So you delete these lines. False alarm. You go back to your date or your walk in the woods. Right?
Mm-hmm.
Right, guys? Come on, talk to me. Talk to me. Feed me back. I need to know you're tracking with me. This is an interactive session for a reason.
Yes, sir.
And then on Wednesday, it gets to the next 4-hour low. Once it gets there, you go down to 1 hour chart and you wait again. Does it come back above the low? Yes, it does. Right? Where is the last high before it got there? What 1 hour high drove it down in there? It is this one. Can you see, right? This is the last 1 hour high before we come down in here.
Mm-hmm.
So you draw that line out and you don't do anything till price breaks the market structure at that level. Where does that happen? On Thursday, right? Can you see that?
Yeah.
It breaks. And so once it breaks it on Thursday, you then look for a retracement, meaning once it passes that high, where does it turn around and give you a swing high in the same candle? The same candle that breaks it happens to be the swing high. There's a lower candle to either side. So this is then your Fibonacci range from here, right, to there. Right? Can you see that?
Yes, sir.
Does it come back to the 61.8 level?
Yes, it does.
So it's a live Fibonacci, right?
Mm-hmm.
Okay. Now, since that is the case, this Fibonacci range, right, is not entirely accurate because there is another high, there's a swing from here to 1 second. Even though it hadn't broken that structure yet, there's a swing from here, right, to here. Can you see it?
Yeah.
And then it gives you a discount retracement before it goes back up here.
Yeah.
In essence, if that is the high that broke the market structure you were waiting for, well, that should be the low that you're taking your trade off. Do you see that?
Okay.
This comes down into a discount here, right?
Yeah.
Well, if I were to now use my entry pattern, remember, I am looking for an order block, right? I'm looking for a return to an order block, preferably taking out intermediate liquidity and a 1 hour reaction. I get that here. I also get that here. This is a 1 hour doji. This is a 1 hour classical Harami engulfing. Either of these two candles, right, would have gotten me in the trade.
Wow. I'm thinking, man, if you use the first doji as
Your stop loss would have been very high, right?
no, not, yeah, it would have been very high if you used the first doji, but like the one that entered into the other block, if you used it, you would have probably been going through a lot of emotional stress when this the down move was coming before
Yes.
walking.
Yes, which is why I wouldn't take this kind of trade. There's no point. It's too far. I would have let it go if it never came back, because why would I? What? 1 second, look. That means I would be entering here and either putting my stop loss here or there.
Mm-hmm.
It's way too far for me.
Yeah.
Also, when you see this, relax. When you see either a huge doji or a huge marbuzu, there is a very high chance price is coming back, right? because this here means it moved so quick. A market maker is unlikely to get all their orders filled. But even if it doesn't come back, fine, just wait for the next swing, right? But in this case, it did come back. Now, this is where the entry comes in now. My entry would be at the engulfing. Once this candle closes, right? That's the candle that engulfed. I'm in there. I have two places I can put my stop loss. The first is beneath the candlestick formation. If I'm scalping, I'll put my stop loss there. If I am not scalping, I put it at the bottom. Meaning if I'm planning to hold for at least more than one day, I'll put my stop loss there. Why? It could easily come back in there the next day to take some more orders. So this would be my scalping stop loss. This would be my intra-week stop loss. And then I'm looking for a minimum of 3 to 4 to 1. I'm then asking myself questions. Where are the places where price could turn around going up? Well, I need to look at liquidity profiles in the past. This would be the first one here. In essence, price could rebound off that level. It could come up here, right, and turn back, but it's already done that here. If it did that there and did not make a lower low, I'm fairly confident it wants to take out that high, okay? If it takes out that high, where's the next liquidity profile that could turn it around? It's this order block there, right? And as you can see, it did. You see that there?
Yes, sir.
So if I'm scalping with that entry, with that stop loss there, when you scalp, you must either, my rules, I'm either getting out at the original high of the Fibonacci range, right? Or at the next liquidity profile above it, immediately after it. So if I'm scalping, I'm either out here or there, because I know I will get a retracement. I know I will get a retracement, and that retracement could take out my entry to pick up more orders. But if my stop loss is at the bottom of the zone, then I have confidence that even if price comes back down, now that the market structure is moving in a bullish direction, and if I am in line with my bias time frame, I expect a long-term move. So even if this came back down in here, even if this came back down in there, it'll just be to pick up more orders from there. I would still expect it to bounce higher again. Right?
Yes, sir.
Now, if I'm not scalping, I've showed you how I would do my entry if I'm scalping. So it'll be my stop loss goes beneath the candlestick that engulfed, right?
Yeah.
My exit is either at the so remember we took this entry because we had a discount Fibonacci retracement from here to there, right?
Yeah.
So I'm either out at the top of the Fibonacci, that's here, or at the next liquidity profile immediately above the Fibonacci. In this case, it's only about 2 pips. This could have been higher. This, if there was no other block there, let's assume the next one was here, then it would have been up here. But I'm getting out here or here because I know there will be at least a short-term retracement. And that short-term retracement could take us back into the zone. So if you are taking a scalp, get out either at the high, or if you're shorting, the low of the swing, or the immediate next liquidity profile. It could be an order block or gap or whatever above it. And count. Do you get at least 2 to 1? That there, let's call that 8.5. Let's call that 9 pips. So I'm not taking this trade unless I get 18 pips, right?
Yes,
Do I
sir.
get 18 pips? Yes, I do. I get even more than 3 to 1. Then this is a valid trade for scalp. Does that make sense?
Mhm.
Yes.
So this would be my scalping entry pattern.
Okay.
1 hour engulfing, put your stop loss beneath the engulfing pattern. Get out either at the original high or the liquidity profile just above it.
Mm-hmm.
And you must have at least 2 to 1. So 9 pips, 34 pips, this would be a valid trade. If this high was down here, let's assume it was down there. Would I take the trade?
How many?
I don't think you would take the trade.
Why wouldn't I take the trade?
I wanted to know how many pips was it from the last one. I can't see.
Okay. Well, it is 14 pips when my stop loss would have been 9 pips. Do I take that trade?
Well,
No.
on a pip level, I think you get, okay, no, 14 to
No, there's no equivocation. Just no. Simple. It's a simple no.
Mhm.
It's not 2 to 1. So it's not a valid scalp.
Mhm.
So that's part of my entry pattern. So now let's go back to our PowerPoint slide and write out that particular entry pattern.
Okay.
Right?
Mhm.
Yeah.
So Israel's scalping entry pattern, right?
Mhm.
Number 1, wait for a discount retracement into a liquidity profile, LP, right? In bracket, preferably an order block or manipulation block, right?
Yes, sir.
Mhm.
Number 2, place your entry at the close of the engulfing candle, the engulfing H1 candle, right?
Mhm.
Candle must close, right?
Yeah.
All right.
Number 3, place your stop loss beneath the engulfing pattern. So beneath the, well, let's make it easy. Beneath the engulfed / engulfing candlestick, whichever is the lower, right? If it's one candlestick like a doji, then just put it beneath that one. If it's 2 candlesticks like a harami, whichever of the 2 candlesticks is lower, either the one that was engulfed or the one that is engulfing, place your stop loss beneath it. Okay, whichever is lower. Actually, stop loss is put above / beneath, because whether we're going up or down, whichever is, so if you place it above, it should be whichever is higher. If you place it beneath, it should be whichever is lower, right? 4,
Mhm.
place your take profit TP at either the high of the fib retracement or the immediate liquidity profile above it. So either the high of the fib, so high / low, or the fib retracement or the immediate liquidity profile above. So if it's high, then it's above. No, it should be low high here because we're going from, so let's do that. The low to keep it in same cadence / the high of the fib retracement or the immediate liquidity profile. So if it's a low, if you're putting your take profit at the low, then it'll be before beneath / above the fib low / high, in bracket minimum 2 to 1 risk to reward. Does that make sense? Let's go back and look at it again. We've done our scenario, we've done our signal. So we got the scenario when this came back. The scenario was this took out the 4-hour stop hunt, right? And then on a 1-hour chart, we had a market structure break there, right?
Yeah.
So that's the scenario. No, so 1 second. That's the scenario. What is wrong with this thing? That's the scenario, right? We then, the signal is, we then wait, do a Fibonacci retracement. It's coming back into the range, into the order block. The entry then is a 1-hour engulfing coming out of the order block, right? We enter, well, the signal actually is that it comes back into the order block for discount retracement and then gives a 1-hour engulfing out of it. That's the signal. The entry is on the close of the engulfing candle. So here we're going up. So the close of the engulfing candle, our stop loss is beneath the engulfing pattern. And our take profit is either back to this high here. That was the Fibonacci range high, or the liquidity profile just above it, which is that one. That's the first liquidity profile just above that high. And we must get 2 to 1. Let me see if I can show you the same rules on a bearish trade. We need to go back in time. So let's go back to a 4-hour chart. We need to look for a 4-hour. Okay, there's one here. Actually, let me use another one I haven't marked out already, so it doesn't look like I picked it out in hindsight. Okay, so 4-hour chart, right? We're looking for a 4-hour. All right, so you see this 4-hour high there? Can you see it there?
Yes.
All right. So like I said, you don't start worrying yourself if you can set up, Kieran, we were talking about doing automated trading. This is an example of where automation would help the trading. If we can design an expert advisor that tells us every time a 4-hour high is breached, you can go about with your life, you can do your work, you can hang out, spend time with your family. You got something on your phone that gives you an alert on any number of pairs you have preset. Tell me when price takes out a 4-hour high or low. In this case, it's taking out this 4-hour high. You drop down to 1-hour chart. That was 1st of May. Okay. You drop down to 1-hour chart. 1st of May. And you wait. First of all, does price reverse? It reverses here. So that's the first part of the scenario. Secondly, you need a market structure break of the level that drove price into the high. Now, this was the last low before price ran up and closed above the high. This is the last 4-hour low there. So 1-hour low. So you wait for market structure break there on a 1-hour chart. This is all still scenario, by the way, guys. This is still the scenario. And Kieran, I don't know if you can hear me. I'm assuming this is all stuff we can automate, right?
He said doable. He texted doable. I don't think he can use
Okay,
it.
cool.
Yeah.
Cool, that's fine. I can't see the chat screen. That's fine. So once this, right, is done, we're now looking for a Fibonacci retracement. It keeps going, it keeps going, it keeps going. This is the first turn. Remember I said when you draw your Fibonacci, so that's the high, that's the low. Does price get back to the 38.2? No, it doesn't. So that swing is not live. You just extend it. This will be the next one. Again, does it get back to the 38.2? No, it doesn't. So you extend it to the next one. Does it get back to the 38.2? Not quite. Don't cheat. This is where not cheating will help you, right? Are you following me?
Yes,
This
sir.
is where following the rules will save your life. Because it would be so tempting. It would be so tempting to say, well, that's only a pip away. And sometimes you get away with it. But then there will be the one trade that will burn you, that will scar you. So you go to the next one. And then here, now do we get a 38.2 retracement? We do. From this point, this fib is live, right? Also, and it goes further up. This is also the beauty of not breaking the rules. Remember, you want price to return to the area of the market structure break, don't you? And it only does that here. So now you have a signal. The signal is price has done a discount retracement back into the area of the market structure break. It has taken out intermediate liquidity there and there, and it has ended up in a liquidity profile. What's the liquidity profile? It is this manipulation block right there. Can you see that? Can you see that?
Yes, sir.
Yes, sir.
Now we have a signal. All we have at this point is a signal. Somebody say signal.
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 Now, how you take this signal is up to you. We now know that at this point here, there's a signal. There are many ways to take this signal. And like I said, as you mature as a trader, you will gravitate towards your own entry patterns, or you could copy somebody else's entry pattern that feels very comfortable for you. There's at least 4 ways I could take this trade. Right? Now, the way I like to take it, the way I have chosen to take these kinds of trades now is this. If I am scalping, this is the candle that entered the zone, right? I need to see that candle engulfed. I need to see a candle close beneath that level. The first candle that closes beneath that level, in fact, let me draw that level out. There, that's the level, right? So I'm going to put that in blue. The first candle one second, I'm trying to get that other line. The first candle that closes beneath that level is this one there. So my entry would be at this one here. If I'm scalping stop loss is directly beneath, above that engulfing. That's where it engulfed, right? So my stop loss would be here. I'm going to put that in red to mark a stop loss. That would be my stop loss. This would be my entry. No, that's not what I wanted. This would be my entry. I'm going to put that in green. Oh, not you. Okay. You. Be my entry. I can just delete this one now. Now, the question is, where is my take profit? All right. Now, remember, this was the Fibonacci that we drew to get that discount. In this case, it's a premium now because we're shorting. So that's a premium signal. That's the Fibonacci we drew, right? Right, guys?
Yes.
Yes, sir.
Okay. So to get out, sorry, actually that should be blue. Sorry, that's an entry. That should be blue. So take profit line, that should be green. So that should be blue. So to get out, I have two options. Option one is this level here, right? So that's this line. This is option one for my take profit. So let's put that in green. Option two is, since we're going south, what is the next liquidity profile immediately south of this level? That would be this cascade of order blocks here. There's quite a few order blocks in this region. So to be on the safe side, what I would do is take the highest level to the lowest level. So which order block starts the closest to that level? You could argue it is that one there. Actually, no. What am I saying? No. There's an obvious one here. Look at that. Can you see that? Remember I told you that when you see a candle with the wick bigger than the body, it's hiding either an order block or manipulation block.
Yeah.
So that's that there. If you drop down to a 15-minute chart, I'm sure you'll see it. There we go. Is that it? No, that's not it. No, 1st of May. 1st of May. There we go. Come back. Right. Can you see that? That's the candle there. So let's adjust it. Right. See, that looked like a bearish order block. Then it was violated to the upside. So that becomes a manipulation block. Remember? Right.
Yeah.
So we go back to 1 hour chart. There it is. So you see, that is the first liquidity profile immediately south of the Fibonacci level. Right?
Yeah.
Do you guys understand that so far?
Yeah,
Yes,
definitely.
Therefore, the second potential exit is here, the top or the entry to that block. So if we then take this away, if I am taking this entry as a scalp, I can only get in here. My stop loss has to be at least there. And I must get out here or here. So do I get a 2-to-1 chance at either? That's 22 pips. This is 47 pips. This is 52 pips. So is this a viable trade?
At least 2-to-1.
Yes.
Yes, it is.
Now, will price eventually drop further than there? Yes, it does. But this is why on a scalp, you get out where I told you to get out, right? Let me show you why. to get rid of that. Remember I said the safe entry for a long-term trade or safe stop loss for a long-term trade is at the other side of this entry block, right? Remember I told you that?
Mm-hmm.
That if you want to do anything longer than a scalp, you need to put your stop loss there. Remember I said that, right?
Yeah.
This is why.
Yes.
This is now, I don't know if I've used this term yet in the tutorials. So if I haven't, you might want to write this down. This is the sponsoring profile. It's the sponsoring liquidity profile, means that is the liquidity profile where the order that generated the trade originated. So we're going to call it the sponsor. Let's put that in green since the arrow is in green, so it doesn't look like a rainbow coalition. That is the sponsoring liquidity profile. Price has the right, following institutional order flow, to come back to that sponsoring liquidity profile as many times as it wants. Does that make sense?
Yeah.
If that is where the move originated from, it can come back there several times over and over and over again. When it is violated, it means you got the trade wrong. So if price violates this, then your trade is done, meaning you picked the wrong sponsoring profile, go back to the drawing board. This is very common. The price moves away from that place one time and comes back to it and takes out the original reaction, right?
Mm-hmm.
It is extremely common. Now, if it's coming down from here, and this was the Fibonacci, in essence, if that was the Fibonacci retracement, price has already shown a willingness to come down here. So anything in between has already been violated. We don't care. On its way down here, it violated all these ones there. The only one it has not violated now, in essence, what we're saying is this was the profile that stopped it. Well, in case it wasn't the one that stopped it, but this is where the last place it stopped on its way down. If it's going to come back to that block, something is going to have to turn it around. The most highly probable things that will turn it around are this low or this profile. Once it comes here, there is a 50-50 chance it goes back to that sponsor profile. You don't want to be caught in that drawdown. So if you are scalping, meaning you took the easy way out by putting your stop loss there, get out at the next potential turn. However, if you are not scalping and you put your stop loss here, even if it returns, you're still safe. Does that make sense?
Yeah.
Now, this would be very scary to sit through, but you would still be safe.
Yeah, the emotional strain, that's that kind of movement to put on you.
Now, you now know why I say I want to see somebody punished first. Right?
Mm-hmm.
Now, ignore this spike. I'm going to explain this spike in a second. For me personally, when I do these trades, the first time I enter, I scalp it. I wait for the retracement, either back here or somewhere here, and then I take a long-term trade. Well, yes, you're right, Kieran. You probably would have moved your stop loss to zero and be taken out of the trade, true. But even if you didn't, you would still be safe up until this point. Now, this here can happen. Fine. This is a manipulation. There's nothing you can do about it. This is why we say that no matter how good you are at institutional trading, you will take a loss because the market maker will do this once in a while. You followed all the rules and you still lost. Tough. Deal with it. Does that make sense?
Yes.
You're dealing with with manipulative human beings, right? So no matter how textbook your trade, 1 in every 4, 5, 6, 7, 8, 9, 10, this will happen. Deal with it, move on, chalk it down to the cost of doing business. You also will find out these sometimes are news events, right? And all this did was move from this profile to the next profile. What's the next profile above this one? Again, remember, when you see a candle whose wick is longer than its body or the same size, it's hiding an order block, right? Or manipulation block. That is the next profile above. And as you can see, that one was respected. Can you see that?
Yeah.
So when we say all news does is accelerate price action, well, that's what it did here.
Mm-hmm.
That makes sense?
Yeah.
Yeah, it does.
So, but ignore this for now. This was a new spike. So let's assume that that didn't happen and come back there. In which case, if you put your stop loss, also, I should add this to be fair. I'm trying to be textbook, but let me be realistic. When you see two liquidity profiles that overlay each other, what have I told you to do?
Just choose one. Choose the.
Take both of them as one.
Yeah.
Right? You can see here that there's two liquidity profiles back to back. Does that make sense? It doesn't, in my opinion, unless you are scalping, just put your stop loss beneath this one here, because they literally overlap one another. You don't know which one the market maker is going to choose. Right?
Yeah.
Yeah.
In which case, this safe stop loss should be on the other side of this here. Right? Now, okay. Now, this is the 1 hour candle that reacts to it. Are you going to put your entry there? Let's see. So would you be ready to, would you be willing to do this? Put your entry there and put your stop loss all the way up here. Is that an acceptable trade for you?
Oh, wait.
No, it's not for most of you, right?
Yeah.
No.
Yeah, Kiranakti, you just said exactly what I was saying. Could we not have seen the consecutive liquidity profile till? Yes. So we could have, is the honest truth. That's why I said when you see them side by side so close where literally there's an overlap like this, you just take both of them. So now, I mean, truth of the matter is you could do this and go for 4-1, right? If your trading rules, if your entry rules allow you to take a 42 pip stop loss, that's fine. 4-1 is 160, right? Over time, price would have given you 160 pips. If you come from here, right, down there, that's 89. If you keep going down, that was 89 from there to there. So if that's 89, from here to here is another 63, right? So that's 150.
So this is where your patience will have to
Yes.
be in play.
Yeah. So you could have waited several weeks. That's not how I'm built to trade. Right? Let's just call a spade a spade. It's not how I'm built to trade. So I would have let that go. But what that tells me now is I am now in a downward trend. So I am going to draw my Fibonacci from there to there. I'm going to keep drawing it, right, till I get a discount retracement. Do I get that there? No. Right? Does that give me a discount retracement? No, it does not. I'm going to draw it again. Discount. No, it does not. Discount. No, it does not. Discount. Sorry, premium. Sorry, premium. Here it does, right? This is now the point at which using that original trade idea, unless I move to another one, but if I'm stubborn enough to be patient, saying that trade idea should give me an entry at some point that fits my rules. On this day here, when price crosses above here, right, I can now start stocking another trade. So what am I looking for? The exact same pattern. I'm looking for a stop hunt on a market structure break.
But sir, sorry.
1 second. I'm looking for a stop hunt on a market structure break, right?
Yeah.
In essence, I understand, right, that this was the beginning of where I should have been on board with the trade. But it didn't give me a good enough risk management profile to get on board. And so I am going to wait for a Fibonacci swing that brings price back into a premium. Once it crosses the 61.8, I can now start hunting a trade using this as my original reference. So at that discount level now, same process, signal, right?
Yeah.
Stop hunt, market structure break. Stop hunt, market structure break, right? A return of price back to liquidity profile. That will be this one here, this order block there. That fits a discount profile here, in which case it closes down here, right? Again, I can scalp it or I can fully trade it. If I choose to fully trade it, this pair is being stubborn because this is another big stop loss, but it's not as big as the first one, right? That is now 25 pips. Can I manage 25 pips?
Yes.
So if I'm going for 4-1, I'm looking for 100 pips. In 2 days, I get it.
Sir, I was gonna ask.
Go on.
In this place that we saw that we could not start checking for a new trade after the Fibonacci level was live.
Yeah.
The high and the low that you use for the Fibonacci level, wouldn't it have changed as the days went forward? Because
it would. That's why I picked the last one, because I would have been picking it this way, right? So let's do it slowly. Does that give me a discount or premium trade here?
No, it doesn't. It gives you a discount.
Yeah, but I'm going short, so I need a premium.
Yes, so it doesn't give you the premium.
Okay, cool. So the next one, does that give me a premium?
No.
Okay. So the next one, does that give me a premium?
It just about touches the 61.8.
But does it give me a premium?
No.
Okay. Does that one give me a premium?
Yes, it does.
No, it doesn't.
No, further down.
This is the one that gives me a premium. Does that make sense?
Okay.
Now, of course, there are other ways to have, you could have just started again on a 4-hour chart. You could have said that trade didn't work out, and you could have started again on a 4-hour chart, hunting another stop hunt, and that would have given you the same thing. I'm just saying, if you are stubborn and don't want to let go of that trade opportunity, if you are patient, that original analysis will give you another chance. But we could have just said, okay, that's fine. The stop loss is too large for a normal trade. Ignore that. Let's start stalking another 4-hour stop hunt. Well, you would have had a 4-hour stop hunt there, right? That would have been a 4-hour stop hunt. Let's change it to purple. in essence, the next bearish 4-hour stop hunt would have given you the exact same trade. Look, stop hunt, drop down to 1-hour chart, market structure break. Can you see that?
Yeah.
And repeat the same process again. After the market structure break, where do you get a discount or premium Fibonacci retracement? That's the first low that gives you one all the way back up there. And then you take the trade, entry here, stop loss there, go 4-1.
Mm-hmm.
But I'm just showing you that sometimes when you see a new trade generated, if you had been tracking the last trade, you will see that the new trade is actually just a continuation of the last one.
Mm-hmm.
Can you see that?
Yeah.
Yes.
And that's why I tell you to trade not too many pairs unless you are a swing trader and above.
Okay.
Because if you have too many pairs you're trading, you can't see how one move feeds into the next.
Mm-hmm.
Because if you were blind to this, if you weren't looking at what happened there, if your first entry into this move was here, it works, right? So yeah, 4-hour stop hunt, market structure break, in this case, premium retracement into the order block entry there, right?
Mm-hmm.
Does that make sense?
Yes,
So
sir.
you would be fine. But if you remember, if you realize that this started all the way up here, and this is simply a discount retracement or premium, retracement of a larger swing, it gives you even more confidence. Does that make sense?
Mm-hmm.
Yes.
It tells you with more certainty that your analysis is more likely to be correct. And that's why I like to keep the bigger picture when I trade. It helps me answer some uncertainty questions of what's really going on. So let's go back to PowerPoint. And let's now do Israel's non-scalping entry pattern. It's the exact same. The difference is I place my stop loss above or beneath, right, the sponsoring liquidity profile. I've defined what that is to you now, right?
Mm-hmm.
With the liquidity profile that originates to.
And I placed my take profit at, okay, let me go back and show you this actually. Now, if this was my entry, so this, in essence, this was the swing that drove my entry, right? That's the swing, right?
Yeah.
This has crossed the 78.6, hasn't it? Before it reacted. Can you see that?
Yes.
Gerard, Kiran, can you see that?
Okay.
Esther, can you see it?
I think she's working. I'm not sure.
One second. Let's blow it up. So this was the Fibonacci swing that we traded a premium retracement of. From there to there, it came back up there. You can see that, right?
Mm-hmm.
Can you see that?
Yes, sir.
You see that it passed the 78.6. You can see that, right?
Yes.
You guys don't sound confident. Come on, talk to me. Talk to me. I don't want to leave you behind. So I want to be sure you're following me.
Yes. Yes.
Okay. Now, what retracement level, what expansion level did I tell you to aim for if you had a 78.6 retracement? Who can remember those rules?
I can't remember that one. Those ones are both the 100.
I said if it's anything, if it's 618, 1618. If it's in between 618 and 786, 141. If it is 786 or lower, 121. Can you remember that?
No, I couldn't.
Okay, you probably, then maybe you didn't watch the video. Okay, that's fine. So I'm going to repeat that here real quick. 1 second. Let me just put the levels on this terminal. One, four.
Oh, this is actually a full course, man.
Say that again.
This is actually a full course.
What did you think it was?
Good.
What did you think it was?
Ah.
So let me repeat, right? 1 second. Let me go here. Let's see. So let's draw a smaller Fibonacci here in blank space. Okay, cool. No, that's wrong. Something's wrong about that. 1 second, delete. Yeah, I got a level wrong there. Let me correct that. Yeah, that should be minus. Cool. So when you draw Fibonacci from a high to a low, right?
Mm-hmm.
If you're going up, right? So in essence, if you're taking a bullish trade, you only want a trade that comes to at least a 38.2. Remember that? So if you're taking a bullish trade, you want a discount entry. Discount starts from 38.2 lower. Remember?
Yes. Yes.
You don't sound convinced.
Yes.
Sorry, I haven't seen this, so
Okay, cool.
I'm just making notes.
Kieran, you remember?
Kieran can only chat. He can't.
Okay, that's fine. So if your entry is 38.2, let me use colors to show this to you. Actually, 1 second. Let's do this on a brand new chart so that we don't mess this one up. So let's figure out where we are. We're at UCHF here. Let's open a brand new chart. Very important. Very, very important. And this works on any time frame. When we draw Fibonacci range, when we draw Fibonacci range, can you guys see that?
Yeah.
1 second. Let's put that there. So when we draw Fibonacci range, right?
Yeah.
If we're going up, if you take an entry around the 38.2, we're going to put that in blue. You want to get out. It's more than feasible that price will get to the 161.8. If you get in at anywhere between the 38.2 and the 21.4, we're going to put that in green. You want to get out at no higher than the 141.4. Now, this is just to be safe. It's very possible that it still does the 161, but just to be safe. If you get in at anything less than 21.4, you're going to make that red. Again, to be on the safe side, you want to get out by the 121. Does that make sense?
Mm-hmm.
Okay.
I'm going to take a picture of that.
Okay.
I can see somebody else took a picture on their side.
I
Now,
I didn't
if,
take a picture.
no, not you, someone else did.
did.
Now,
Jared.
if you are going south,
Okay.
you're waiting for an entry that's at least a 61.8 because you want a discount entry to sell. So a premium entry to sell. You want to buy at a discount and sell at a premium. That makes sense, right? If you're a seller, you want to sell at the highest possible price. If you're a buyer, you want to buy at the lowest possible price.
Mm-hmm.
So if you take an entry at the 61.8, well, it's the same the other way. You get out at the other 161.8, the minus 161.8.
Okay.
If you take an entry, anything in between 618 and 786, then you want to get out at the 141.4. If you take an entry at or beneath, 1 second, shift, at or beneath the 786, here we go again. I can't stand MetaTrader 4, but then I keep remember it's a very old program. No, sorry, no, that was wrong. Actually, that should be there. If you get in at or beneath the 78.6, then you want to get out at the 121.0. Does that make sense?
Yes.
Now, these are rules of thumb. There's nothing scientific about them. They're just from my own assessment of price action over the years. Use them as you will. There's no law that says it must be this. These are the safety precautions that I have come up with that work well for me. In that case, if that is the case, to grade this potential entry, this is a 78.6, right? You see this? This entry is at or greater than 78.6, right?
Yep. Yep.
So where should we be coming out? Yes, Kieran, you're right about that. In order to be conservative, since price may lose momentum. So if this, let's go back here. It's not a trick question. If we enter at 78.6, where should we come out?
121.
Okay.
Minus
So
121. Sorry.
exactly. So here we entered at or above 78.6. Where should we come out?
Minus 1 to
Okay.
121.
So let's just drop a line there. Bear in mind, we don't know what's going to happen when it's coming down. At that 1 second, let's see. At this point, we don't know what's going to happen. It's just dropping, right?
Yes.
But on our fib chart, we have a line here that should tell us when we get to the 121.
Okay.
Right?
Yeah.
Yeah.
The question now is there a liquidity profile around the 121 that should stop us? And your exit on anything that's not a scalp, your exit liquidity profile should come from your scenario time frame.
Okay.
Does that make sense?
Okay.
So if our signal was a 1 hour, what, for instance, if we look at a 4 hour and we see that at that level there's nothing to make us come out, then just ignore it. But voila, look at that here. Right on schedule at the 121 level, there is an order block here. What do you think is going to happen to price on a 1 hour time frame when it comes across a 4 hour order block?
Go up.
it's going to reverse, right? At least for a while, which is what it does. See, it reacts to it here. Let's go back and look at 1 hour. So this is what we would have seen when price got to that order block, which started at exactly the 121 level. And interestingly, this order block took us all the way from the 121 to the 161. So it was a huge order block. But here you see that it starts to react. Now, if you held up to here and then you saw it come back this high and take out the high of this day, wouldn't you have been worried? If you saw your trade reverse by 41 pips, wouldn't you have been worried?
Yeah.
So, well, not you, Kieran, because you're a swing trader. But if your stop loss was 25 pips, look at this, right? Your initial stop loss was 25 pips. If price on your trade reverses almost twice the value of your stop loss, whoever you are, you will be concerned. And this is why I would say at this point, where do we get so we get 421 pretty much exactly there, right? I'd already be looking to get out around here, which will be about 3.5 to 1. Wait for price to cross that liquidity profile. Wait for it to violate it, right? To close beneath it, to give you a sign that it's now ready, and then you can re-enter. So I am out of this trade here around this level, and I'm waiting for it on the other side to prove to me. So this is the first time this is the first candle where it closes beneath that zone, this candle there. At this level, I now know price wants to go further south, right? Right?
Yeah.
So what am I going to wait for? The whole process all over again to get back on board. What's the whole process all over again? Well, I'm glad you asked. This would be a stop hunt on a 4-hour time frame, right?
Yep.
So where patience comes in, I would then drop down. So once I see price go above here, I would drop down to 1-hour time frame to see if it reacts. Does it react? Let's look at it. Does it react? Yes, it does. Where is the 1-hour order? Where would be the 1-hour market structure break here? It would be all the way down there. Is that viable or feasible? Nope. So I'm going to tell myself, sorry, that trade is over. Go watch TV. However, no, I'm wrong. No. Sorry, no, I'm wrong. Actually, yeah, this is it here, right? This is the 1-hour market structure break there. So stop hunt there. That is the last low before the stop hunt. It breaks it here. I now start pushing my Fibonacci, right? Looking for a live Fibonacci that gives me a premium retracement. And the first one I will find will be that one there. Price comes back up here. Do I get, in essence, I'm looking at this at that time, above the 61.8 level. These are the liquidity profiles I'm looking at. I'm looking at this one. Price blows through it, fine. There's no 1-hour reaction in it. I'm now looking at this one. There's no 1-hour reaction in it, but I get a 1-hour reaction from just above it, meaning it was violated. So that cannot be the sponsoring profile. This has to be the sponsoring profile. That's the next one above, right?
Yeah.
See that there? So I adjust my Fibonacci now. That is the new high. So what am I saying? No. What am I saying? So I adjust my Fibonacci to that, then becomes the new high, since that's the one it respected. This I would be worried about. I'm just being honest with you. I wouldn't take this trade. It turns out well, but I wouldn't take that trade if that was all I saw, because I'd be worried that this would be violated. Those seem like equal highs to me. However, if I put that there, and then I can convince myself that, okay, that's a 61.8, right? That's a 61.8. That's, I honestly speaking, it turned out well, but I'm being honest, I wouldn't have taken it. I'd be lying to you if I said I would, right?
I think I would have. I think I'm risky like that.
Well, and you'd be right. That's fine. That's depends on what your risk profile is. I'm just being honest with you. To me, that would look too risky. However, this is how I would have taken it. Let me show you how I would have taken it.
Okay.
Remember, I was in here and I got out there.
Yes.
I would have taken it as a continuation of the first trade.
Okay.
And gone and put my stop loss all the way back up there.
Okay.
And told myself I am now, so I would have used the same entry, the same entry size, right? And I would have told myself, you are now continuing from a trade you got out of. Remember, I got out of the trade of this green line. I would then tell myself I'm back in the trade. But my original stop loss would have been where it would have been. Or if I'd moved my stop loss to even, it would have been back at even. So I would have re-entered it as a continuation of the trade I jumped out of the first time. But I would not have taken it as a brand new trade and put my stop loss here at the beginning.
Okay.
And so if I'm taking it as a brand new trade, right, then the question then becomes again, where's 421? In which case, if this now, I then adjust. So that's why I said I would then have adjusted my Fibonacci to say that was the origin. This is now the furthest expansion. It's come back to the 61.8. I'm now looking for 161.8 exit here.
Okay.
Right? And then I would have calculated again the 421 on the original trade. So the original trade's entry was roughly, if I remember correctly, around, it was there, right? We entered in here with our stop loss up there, didn't we? So from here to here, of course, you easily get more than 421. But this is what you have to ask yourself. Do I have 421 extra on the 421 I've already banked? Is it worth continue? Is the potential benefit of continuing this trade worth an extra 421 to me? So where did I get out? I got out at the green line. From the green line to the blue line is 100, basically 200 pips. My original stop loss was 25 pips. Is it worth it? Yes.
Yeah.
If it's not, then I stay away from it. Why potentially give up the 421 I've banked if I don't have at least another 421 on offer? Does that make sense? I know I'm starting to get into some advanced territory here, but on a general basis, does that make sense?
It does.
So that is how I would frame that potential entry. So we come back here, put your TP at either the low or the high, or the immediate liquidity profile beneath or above the. So I put my take profit would be at the appropriate, in bracket, 161.8/121.0/141.4 fib expansion that lines up with a reversal liquidity profile on my reference time frame, meaning the time frame above my signal one.
Okay.
Now, I know that's a lot, so go back and watch this again.
Sure.
That's an example of how I would practically apply some of the concepts that I've just given you in, and of course, let's go check that as well. Let's drop this line here. Can we find, so let's go back to, so 4-hour chart. So we're asking ourselves what, so this is the line we're looking at. What justifies picking this as an exit? See, we're here, right? Where's which liquidity profiles are around here? Well, there's one here. There's a manipulation block there. However, there is a higher order block that starts from there. So I would always take the safer one, right?
Mm-hmm.
In which case, I would have been out around this level there.
Okay.
So I wouldn't wait to get out there. I'd have been out here, which would still have given us more than an extra 4-1 anyway.
Mm-hmm.
So I would have been, in essence, I would have entered the trade here, right? Again, put my stop loss all the way back up there since I'm continuing the original trade. Of course, at this point, I would already be moving my stop to 0 or to even. So I would adjust the stop to above here, because if I was in this original trade, by the time this formed and dropped, I'd be moving my stop loss down, but I'd be out here. So that would give me an extra 128 pips. So overall, I would get 222 pips from a 25 pip stop loss trade. That's almost 10-1. You get one of those trades a week. Can I warn you guys? Can I plead with you? Everybody listen to me. Even for those of you listening who may be older than me, age-wise, treat me as older in trading years. So see this as the advice of an old man in trading years. If you get a tiger of a trade and bank it, stop trading that week.
Okay.
I know it goes against all intuition, because when something is going well, you see, this is how human psychology sabotages us as traders. When something is going very well, you want to stop. So you want to carry on. When it's going bad, you want to stop, right? So when you are losing, you want to stop. You want to quit. Well, actually, no. You should be turning those losses into lessons to take better trades the next time. So a loss, while it deflates you and makes you not want to trade again, should actually make you go into the next trade with more discipline. When you're winning, so let me rephrase that. This should be a psychology class, but let me end with this. Let me phrase it properly. Losses make us more careful. Wins make us less disciplined. Can you follow that for now?
Yeah.
When you're doing well at something, you feel invincible. When you're doing poorly at it, you second guess yourself. So a loss will make you miss out on the next trade you should have taken, because now you're second guessing your rules. That's why I said be comfortable with losing. If you checked off every single rule on your list and you still took an L, shake the market maker's hand and say, see you next time. Don't be gun shy because you lose. If you're following the rules, take a loss as either something that shows you the rule you did not follow, or an aberration, and move on to the next one with confidence. Yeah, Kieran, that's exactly what I'm saying. You play the odds. Now, when you've taken a big win, you are going to feel invincible. Secondly, it is very unlikely that the same pair will give you multiple tigers in the same week.
Okay.
It's not possible, it's unlikely. That one pair gives you 2 10-to-1 trades or 2 8-to-1 trades a week without any manipulation. By the time, if you ride a huge move from start to finish, you should be expecting the market make a correction or manipulation. Secondly, you're going to feel invincible. You're going to want to put more money in. You're going to go empty out your 401k or your pension and say, if I put my whole account into the next trade and I get 10-to-1, I can retire. That's where mistakes happen. Right?
Yep.
As a beginner trader, if you get a tiger, quit for the week. Let me repeat. In the early days of your trade, until you have a firm grasp on your emotions and all potential market profiles, if you bank a tiger, what do I call a tiger? I don't know, anything above 7-to-1, any 6-to-1, 7-to-1 and above. Basically, anything that makes you go, wow, makes you so excited that you feel like you're invincible. Just say, okay, cool. I'm done for the week. I'll be back next week.
Okay.
Will you say, man, I could have gotten that second tiger sometimes? Yes, you would have. But trust me, you'll also have prevented yourself from giving the money back. And then as you get more experience and more in control and in check of your own emotions and more in sync with how the market moves, then you can stay in longer every week to potentially bank multiple tigers.
Okay. Got it.
Let me give another definition of what I mean by tiger. When I tell you to build, when you build your trading plans, one of the things I'm going to tell you to include in your trading plans is the number of entries you plan to take a week or a month, depending if you're a swing trader, an intra-week trader, whatever. So let's assume that you're an intra-week trader. Your trading plan will also include, like, I plan to take 5 trades this week and I hope to win 3 of them. Right? Or 3 trades this week and I hope to win 2 of them. Are you following me?
Yes.
Okay. So if you plan to take 3 entries and win 2 at 4-to-1 each, that means you're up 8%, right? 4%, 4%. So if you're risking 1% each time and you have 2 4-to-1s, that's 8%, right? Don't just say, do you get it? Do you understand? Or do I need to explain what I meant by that? If you risk if you risk 1% on a trade,
yes,
and you have a risk to reward ratio of 4-to-1, if you win that trade, you're going to make 4%.
Okay.
Do you understand that?
Yes.
If you're risking 1%, so 1% of your account on this trade is your stop loss, but your take profit is 4 times your stop loss.
Yes.
If you win that trade, you will win 4%, right?
Yes.
Okay. So if you take 3 of those trades a week and you win 2, it means that you will have made 8% on the wins, right?
Yes.
And on the one you lose, you will have lost 1%, right?
Yes. Yeah. No, I get it.
Okay. So over those 3 trades, you'll be up 7-to-1.
Yes.
Well, if you take your first trade and it gives you 7-to-1, why are you coming back for the other 2?
No, you just call it a day.
Call it a week.
Cause some tea.
Right? Now,
Yeah.
if you're going for 5 and hoping to win 3 times 4 is 12, right?
Yes.
So on the wins, you'll be up 12%. On the losses, you'll be down 2%. 2 times 1. Right? So if you do 4-to-1 over 5 trades and hope to win 3, you're hoping to be up 10% at the end of the week.
Okay.
If your first 2 trades give you 10%, why are you coming back for the last 3?
Don't have to.
Now, when you get more matured, you can, because you will stay out of the traps. In essence, you have less possible mistakes you can make. Your psychology is a lot more robust, so you're not likely to be trading emotionally. But as a beginner trader, if you hit your weekly objective in your first or second trade, go home.
Okay.
Right?
Yeah.
Let me repeat. As a beginner trader, if you hit your weekly objective in your first 1 or 2 trades, the odds are more than likely that if you keep trading, you will give that money back or some of it back.
Mm-hmm.
And when you lose your next trade, you'll be shocked what happens to you emotionally. Even though you're still up on the week, some stinking devilish voice will tell you you've messed up your perfect week. Take another trade to get that money back. And another one. And another one. It's like gambling. If you gamble and you beat the house, what does the casino do? For those of you who've ever watched gambling movies before, I know none of you have ever gambled before. Don't say I'm wrong. I'm just going to believe that none of you all look like such fine, upstanding citizens that you've never addictively gambled before. I don't want to know if I'm wrong. But we've all watched gambling movies, right?
Yep.
When you win, what does the casino do?
They invite you back to the
They
table so they
invite
can
you
take your
back
money
to the
back.
table. They want to get their money back.
Mm-hmm.
They're going to buy you drinks. They're going to send you complimentary tickets. Yeah, Kieran, you're right. Complimentary tickets to spend a free 3-night retreat at their resort.
Mm-hmm.
They're going to keep pampering you, to use Kieran's words, and keep seducing you is the word I was going to use. Because they know that the more you win, the less disciplined you are going to be psychologically.
Mm-hmm.
Except you're a pro. Be the smart kid. You're right, Kieran, who quits while you're ahead. Divide your trading life into blocks. It could be days, weeks, or months. If you're a scalper, it's days. Meaning, if you're a scalper, you're probably going to be taking sometimes up to 5 trades a day.
Mm-hmm.
If you've met your daily objective in the first 2 trades, go out, go chill, come back tomorrow. If you're an intra-week trader or day trader, you're probably going to be taking 3 to 5 trades a week. If you meet your weekly objective by Tuesday, quit for the rest of the week. If you're a swing trader, it'll be 3 to 5 trades a month. If you meet your monthly objective in the first, now that one's a little bit more difficult. So if you meet, for a swing trader, if you meet your objective at the start of the month, I'm not going to say don't trade for the rest of the month, but take a break. Don't come back looking for another trade tomorrow. Take a good 4 or 5 days away, right? In essence, get to a point in which you reset your counter until you can ignore your win and say we're starting from scratch. Now, when you get more experience, you can do it automatically. You can take a big win, go buy yourself a drink down at the local Tesco or Walmart, and then in 2 hours you've erased it from your memory. Great. But it's going to be hard to do that as a new trader. So until you have expunged the joy and the exhilaration of having met your target, stay out of the market.
Okay.
It hardly ends well. Right. Any questions before we shut down for today?
No. Thank you very much. It's been very informative.
Thank you, Monica. Anybody else have any questions before we shut down for today? All right. Well, it will be up on YouTube in a little bit. I will send you the link once it's processed. I will see you guys on Sunday night. Have an exceptional weekend. God bless you. Bye-bye.
Thank
Yes,
you.
thanks. Bye.